bank is lending its own money with funds that it truly has on deposit, and it is holding onto that loan and it is servicing that loan, sure, they could absolutely set any interest rate they want, but that's just not how it works. I agree with what you're saying. In theory, a bank should make more if they are charging a higher interest rate. Let's say we're talking about a depository bank. I'm talking like Wells Fargo, Chase, one that you can go in, put money in, and then the bank is going to use those funds to loan to other customers. And in exchange for lending out your money, the bank is going to pay you some interest, and that's going to encourage people to continue to deposit money. When interest rates go up, they pay a little bit more in interest. And because of this, the bank doesn't actually have those funds literally in their vault ready to go. Regulators do require that banks have a certain percentage of those funds in reserve to support the bank's stability and solvency. The amount of money that a bank has on hand is going to vary depending on the day, depending on customer withdrawals and loan repayments, loans that were given out, deposits that were made, etc. And because of this, banks have to borrow money overnight from other banks in order to meet the reserve requirement, depending on what activity has happened in the bank that day. And this is where the Fed funds interest rate comes into play. That is the interest rate that banks charge other banks overnight to borrow money. So if it becomes more expensive for the bank to borrow money, it's also going to be more expensive for you as a consumer because they're going to have to charge a higher interest rate in order to make that up. They also have to pay a higher interest rate to encourage people to continue to deposit their money and hold it in the bank. And when interest rates are higher, people are less likely to take out loans. So they're not making the interest that you think they are. They're doing fewer and fewer loans. Yet they're still servicing the loans that they made at 2 and 3% interest, so they're not making a ton of money on that in order to offset the higher interest rates now. This also explains that why when the Fed raises the interest rate, while it doesn't directly raise mortgage interest rates, it influences them, because if a bank is going to be having to pay more money in interest, they're going to in turn have to charge more money in interest.